What's up, guys? I hope you're doing well. So I found an interesting, webpage on the Dallas Fed's website, and mostly about how exactly should we kind of, judge the government debt, right? And so should it be more like I don't know, like based because it is like government bonds and such, make this not so bad. But come on, there you go. But anyways, um, basically making it to where should we judge it based off of its market value because they are treasuries, or should we base it off of the par value? And apparently, a lot of the times, they basically just do par value, and so it really gets into the a little bit of the nuances of like who's owning what and kind of shows the differences. So we'll just hit the screen share and head on over there. So there, all right, and then make it bigger. There we go. Okay. So, for many uses, market value more accurately represents the debt burden faced by the U.S. government than the par value. The par value of government debt, which is reported by the U.S. Treasury Department, reflects interest rates at the time the debt was issued, while the market value is adjusted to reflect market interest rates as of the observed period. And so, they're kind of arguing that this was more of by using market value, it's more of what the debt kind of burden is at this second, at this current environment, debt levels, whatever. Um, and also, par and market values are reported for gross federal debt, which is all debt issued by the Treasury. Privately held gross federal debt that is not held by the U.S. government accounts or by the Federal Reserve, and marketable Treasury debt, which is your Treasury bills, notes, and bonds. Values reported are for the last business day of the month. So all of these were basically all the values are reported for the last business day of the month pertains to these charts down here. And so basically they have, I think it's four charts. One and two plot the par and market values for the U.S. government debts, and then they separate two of them because they're really close together. And so I think it's which ones do they separate? So, marketable Treasury debt and privately held gross federal debt are plotted in separate charts because they are generally very close to one another. This means the U.S. government debt held by the Federal Reserve and privately held non marketable U.S. government debt has historically been roughly the same. And so, kind of putting that non marketable term in there is rather important because it really defines the kind of debt there are or there is, or whatever that they're using, and they separate it more in depth later. So right now we'll just kind of go over the charts themselves, which I haven't before the video. I kind of haven't really gone over much. So we have the dotted lines, which looks like the par value, and then the solid lines are market value. And so you should see that the market value, it seems to be regularly slightly higher, and I'm assuming this is 1980 to 2020 by the dates. Um, they get this data from the Treasury, Federal Reserve Bank of New York, the Wall Street Journal, and Bloomberg, and a few other things. And I think they talk about it more in depth later on where exactly they get the debt sources. So I think that's at the end. Um, and so we see, gross federal debt since the 80s has basically gone straight up for the most part. And then we have gross federal debt. What's the difference between these two? Oh, and the blue is privately held. Okay. Okay. So blue is privately held, and then the black, I guess, is just total. So total debt. So the spread would be, I guess, is held by the Federal Reserve or non-private entities, so other governments maybe. Um, Now in here we have market value as a share of GDP, and so it's kind of, I guess it's kind of a not necessarily an equivalent, but I guess an analogy, or it's analogous to like the debt to GDP ratio, which I guess U.S. government debt. It's kind of exactly what this is. Now that I actually said it out of my mouth, but as you can tell, using the market value, it's kind of the story where it seems it's at least in recent decades, it looks that the market value is actually higher than the par value, um, which would make sense. I guess it does make sense because it's what we said they had like a 40-year bull market or whatever in terms of interest rates. So like interest rates have been lowering, and so you kind of see the difference here between the market value and par value, where 40 years ago was the 80s, right? And so basically, as interest rates were lowering, obviously the price of the bonds and stuff would go up. And so we see that with the market value being above the par value for each, basically from 80 onward. And then you see the complete opposite um, prior to 1980. And it looks like this chart goes back into the 40s, where we kind of see that spike of debt to GDP due to World War II. We know kind of decreased a little bit for other monetary policy reasons that no need to get into in this video. And again, we see the kind of the spread between these two is where I'm assuming the black lines are total, and then the blue line's just the privately held version. I mean, it doesn't state otherwise, and so that's just kind of an assumption. And like with all Fred charts, the gray bars are always the recessions, right? And so we'll go down to more, and this is where we have this is the difference. So the first two in chart A or in chart 1, A and B is privately held gross federal debt. And then down here is where we split it to where now the red is the marketable treasury debt. And so this is like the actual bonds, bills, and notes and stuff that are marketable. You can sell them in a market. Because there are forms of federal debt which isn't marketable. And we'll go into that a little bit later. I think a lot of those are used by trust funds, if I remember correctly. Like I think somewhere later we'll talk about Social Security. But like for an example of like individual non-marketable treasury debt, I guess would be like the I bonds or whatever they're called, the ones that you can it's like they sort of follow inflation. Like the interest rate on the bonds is revised every 6 months or so, and it's non-marketable. It'll only pay out to whoever the owner of the bond is, I think. Um, I don't think you can buy those in a brokerage because you can't trade them. You can't really sell them, at least to other people. Anyways, try not to get off topic. Kind of the same story, it seems. You have the market value, kind of follows the same trend. I'm assuming the black line is the same as in the previous, and we're just showing the different ones. And so the red is for the marketable treasury debt. And then I guess coming down here, we'll see if it's the same story in terms of the relationship between market and par value, where we have 80s. The 80s are here, and it seems to be the case, just maybe not to the same extent for marketable treasury debt. It seems like that spread between market value and par value may be slightly smaller, at least from the eye, maybe not. On pretty much the same general trends to begin with. I mean, a big thing to note is, all of it, regardless of its which section, I guess, or which type of debt it is, have all been increasing as a share of GDP. Also, let's see, notes on June 30th, 2021, data was corrected for observations from July 2020 through May 2021. So some securities issued in that time span were previously excluded from the marketable debt series. These securities are now included. So I guess that's kind of applicable to if we're looking at times that are relatively recent. Looks like the charts only really go into the 2021 section. So pretty much through May 2021, just kind of eyeballing it. So yeah. Some of them aren't included to begin with if there's new data. Oh my lord, I can't talk for some reason. Anyways, So official statistics on government debt are reported in terms of par value of the debt securities. Again, how much must be repaid at the maturity date. However, for many purposes, the market value, which accounts for changes in interest rates since the debt was issued, is more accurate. Is a more accurate representation of what the federal government actually owes. And I guess I don't remember if they stated this in here on this webpage, but that pretty much it seems predicated on the government actually buying back those securities, right? And so not allowing them to mature, because if they allow them to mature, I mean they're fixed income instruments, so you'd go based off the par value anyway. So I guess the only reason you'd really um, choose to kind of judge it based off of the market value would be if the government was planning on buying those back before they matured. Um, that's all I could. Otherwise, I don't see how it really makes much of a difference. Um, anyways, basically, they give an example of like why this is the case, of why they'd choose marketable value over par value. And so in their example, they're like, okay, say you have a bond of $1,000, that's par value at 5%. And then if interest rates go down to 4%, the market price of that bond would be 12.50, right? So it'd be paying the same amount, right? Um, and so basically, if in the market, investors would take advantage of the above market yield for the 5% one, and then they'd bid the price up until it was essentially the price that they'd pay for the bond was 12.50. So you'd end up having like the same price. And so basically, they say the market has a claim against the government represented by the bond. Um, Equivalently, the government would have to pay the market value if it wanted to retire the security by repurchasing it, like I was saying a second ago. So, conceptually, this principle applies to the entire U.S. government debt. So, basically, the whole argument to use the marketable value of the securities, I guess, would be to if they plan on buying back all of it. And they also give it's Cox and Hirschhorn, I guess, 1983, and then Cox 1985. If you want to look more into kind of the details of of these measurements and stuff and how they're measuring stuff, that's their citations for it. Um, Here we go more into the actual components of it. And so the broadest is the gross federal debt, which is that black line that we saw in the above four charts. And that's referred to as the total public debt outstanding by the Treasury and does not include debt issued by federal agencies other than the Treasury, such as the Federal National Mortgage Association. So that debt is in those four charts. These four charts, the black line does not include federal agencies like Fannie Mae, Freddie Mac, that stuff. Their debt is not involved. It seems it's just the Treasury. Um, and so basically, we have the difference between marketable and non-marketable securities. So marketable are like the Treasury bills, notes, bonds, and stuff that you can actually buy in like a brokerage. They're marketable. You can actually sell them and buy them within a market. And then you have the non-marketable ones, which can only be redeemed by whom the debt was originally issued. So like the I bonds and such, to where you can't sell them to anybody. And so, yeah, kind of going into this part. So the gross federal debt can also be organized by who is holding it, a private investor, the government accounts, or the Federal Reserve, as reported by the Treasury Bulletin's table. These two distinctions form 6 categories as shown in Table 1. The Federal Reserve does not hold any non-marketable securities, so there are only 5 categories that could be different from 0. So basically, it's a chart, or well, a table, where you have debt held by government accounts, and then privately held, and then held by the Federal Reserve, where we have the left side is marketable, the right side is non-marketable, and so you can kind of see the weightings a little bit, to where you see privately held is mostly in marketable securities, but they do have $500 billion in non-marketable, which kind of and and then the Federal Reserve again is all marketable, so we see that. And then the government accounts, it seems, is mostly, I'd assume mostly non-marketable because it shows zero here, but it's just showing this box, basically the box that's held by the Federal Reserve and that's also non-marketable. That's the only one that has to be zero because they can't own any of it. So being said, U.S. government accounts hold federal debt securities as a means for one entity of the government to borrow from another, also entirely in the form of trust funds, which are non marketable U.S. government accounts have held marketable securities um, in the past, but not since January 2005. So this is the box I was pointing out earlier where it's actually zero. So they haven't owned any marketable securities since 2005. And then the largest U.S. government account is the Federal Old Age and Survivors Insurance Trust Fund, which, along with the Disability Insurance Trust Fund, um, make up the Social Security Trust Fund. So a lot of trust funds, but basically the non-marketable U.S. securities pays for Social Security. So yeah. Talking about the other ones, but not. And then we have a bunch of like the actual equations and stuff that they use to calculate everything and whatever. And here's a table. It's pretty interesting about where they actually get their data. I'll try to make it bigger and make sure you guys can actually see it. Oh, wrong one. One more. Maybe not. Scroll down. Okay, let's see. How's that? That's bigger for you guys. It's showing where they actually get their data, right? And it shows time frames as well. And so we have gross federal debt aggregates and par value of marketable securities and market prices, then held by the Federal Reserve and privately held aggregate, right? So these are the different sections of which they get their data about, right? And then it shows when they got this data from the Treasury Bulletin and so on. And we see now they get the market prices from Bloomberg. The amount held by the Federal Reserve they get from the New York Fed. Privately held ones they get from the Treasury Bulletin and Federal Reserve Holdings. And then the gross federal debt aggregate is monthly statement of public debt. So there's that one. And then back in the 80s and I guess early 90s, the Wall Street Journal was the one where they got their market prices from, which is kind of cool, I guess. Just kind of seeing where exactly they get their data, because you never know. It could be something that like raises eyebrows or whatever. Who knows? But anyways, that's all I got for this one. I just kind of wanted to, I guess, kind of just show it because I never really thought about, like you always hear all the people are talking about like the government debt and everything else, but it's also like, those are actual like securities and stuff that they're talking about. So how exactly are you going to value those? So should it be based off of market value or should it be based off of par value? I guess it's really a matter of opinion unless the government is going to or plans to actually repurchase all of those securities. Otherwise, at least right now, I don't see a reason why the market value would really be advantageous. I guess with their argument basically being that saying that the market value is more accurate for right now, right? And so basically, it's as if they were to repurchase those right now. So if the government was going to actually buy back all of their bonds and all of their debt at this second, what would it be? But I don't really see how that matters unless they're going to actually start repurchasing them. I don't know. Otherwise, I mean, the interest and like if you're just clipping coupons or whatever, from I guess from the perspective of the government, regardless of how many times their bond is traded between other entities that to where they are not included. Like if you had treasuries being traded between like hedge funds and pension funds or whatever it happens to be, or where, or like if they're used as collateral somewhere by a hedge fund in the repo market or whatever it happens to be at the time. I don't see how that changes what from the I don't see how that changes from the government's perspective because they still have to pay that interest regardless, based off of the par value. And so basically, it's just the market value of that bond is with respect to current like market interest rates and sentiment and such, to where, yeah, I don't know. I guess I can see where they're coming from, but I don't really see where it has that much value, for lack of a better term. Um, I don't know. Pretty interesting. But, anyways, that's all I got for you guys today. So, I hope you guys have a good night, and I'll see you on the next one.